Credit, Lesson 2, What Makes Up Your Credit Score? In this lesson, we're going to cover what different credit score numbers mean, what information is required to generate a score, and the factors that determine how your score is calculated. We provided a cheat sheet to go along with this lesson that you can find in the download section. Credit scores range from a 300 to an 850. 300 is the absolute worst score you can have, and an 850 is considered perfect. The higher your score is, the lower the risk you are to potential lenders. Lenders use your credit score to determine what level of risk you are, and each lender has their own standard for the level of risk that they find acceptable. Some lenders only work with people that have great credit scores, while other lenders are willing to accept ultra-high risk customers with bad credit, and then they charge them super high interest rates on the money that they borrow. So, let's break down what each credit tier means. If you have a credit score of 580 or below, it's considered poor. Not that you're actually poor, just that your credit score is no good. This is well below the average credit score of Americans, and a score in this category tells lenders that you're probably high risk. Next up is 580 to 669. This category is considered fair. This is still below the average score for most Americans. However, a lot of lenders are still going to approve loans within this range. You won't get the best interest rates, which means you're going to pay more money to borrow money, but at least you're going to get approved for a loan. A score of 670 to 739 is considered good. The average American's credit score is right around a 700, so this is a fairly decent credit score range. A 740 to 799 is a very good credit score. This range is well above the average American's credit score, and it tells potential lenders that you pay your bills on time and that you're a safe choice to lend money to, because it's highly likely that you're going to pay them back. If you've got a score above an 800, you're going to be winning at the credit game. This credit range tells lenders that you are exceptionally responsible and very low risk. In order for a credit score to be calculated, your credit report must contain enough information and enough recent information to base a credit score on. Since you probably don't have anything that reports to the credit bureaus right now, you probably won't have a credit score at all. In order to establish credit, you have to have at least one account that's been open for 6 months or longer, and it has to have been reported to the credit bureaus within the last 6 months. This is why you can't just open a credit card and then never use it. That doesn't build credit. If you want to build credit, you have to use the card and make payments on time. This record of borrowing money and repaying it shows the credit bureaus that you're responsible and you're able to pay your debts. While it may seem like a complicated mystery, building good credit is actually pretty simple when you understand how it's calculated. So let's break it down. There's 5 different categories within your credit report, and they're all weighted differently. Payment history is the largest one, and it makes up 35%. Credit utilization ratio is 30%. Length of credit history is 15%. New credit is 10%. And your credit mix is the last 10%. All right, so let's break down those a little further so you have a better understanding of what all this means. Payment history is one of the most important factors, which is why it determines 35% of your score. Lenders report to the credit scoring agencies and let them know whether you're making your payments on time or not. Late or missed payments will bring your credit score down. The single most important thing you can do to boost your credit score is make your payments on time every month, because when you establish a pattern of paying your bills on time, your credit score is going to improve. Next up is credit utilization. This is the amount of credit you're actively using compared to the amount of credit that's available to you based on your credit card limit. So the lower the ratio that you're using, the higher your credit score is going to be. You want to keep your utilization ratio to under 30%. But for the best score, you're going to want to keep it under 10%. For example, if you have a $1,000 limit on your credit card, you need to keep the balance that you owe under $300 in order to stay below the 30% utilization rate. In order to stay below a 10% utilization rate, you need to keep the balance you owe under $100. Using less than 10% of your credit shows that you're responsible with paying your bills on time and not overextending yourself. A lot of people get into the habit of using their credit cards to float their lifestyle, and then they overextend themselves, which leads to debt that's really hard to pay off. And this is absolutely something that you don't want to do, and you want to avoid it at all costs. The length of your credit history makes up 15% of your score. Lenders typically look at the average age of all of your open accounts. The longer your credit history is, the better it is for your score. You really can't do much to control this one other than just letting time do its thing. I had a credit card for almost 10 years, and I made the mistake of closing it when I was in my late 20s. When I closed it, I lost all of the credit history that came with that card, and it actually hurt my credit. New credit makes up 10% of your credit score. However, you don't want to open too many accounts too fast. If you have a short credit history or no credit history, opening several credit accounts in a short amount of time makes you look like a high risk to lenders. It's recommended that you wait at least 6 months between the time that you apply for your first credit card and when you apply for your second credit card. This doesn't mean that you should apply for your second credit card after having the first one for 6 months. It just means that your chances of getting approved are going to be a lot higher if you allow some time in between. When you apply for a new credit card or other kind of loan that uses your personal information like a social security number, the lender is going to run a credit report. This is considered a hard inquiry, and too many hard inquiries can lower your credit score. Don't worry, we're going to break that down in a future lesson. The last part of your credit score is made up by your credit mix. This means you have a variety of types of credit. Some examples are things like car loans, credit cards, and student loans. While credit mix only contributes to a small percentage of your overall score, having a variety of credit can actually help boost it. Aside from these 5 categories, there's other things that can impact your credit score. Negative information on your credit report, like a bankruptcy or an account that goes into collections, can drop your credit score. For example, if you have a medical bill that isn't paid, it'll go to a collection agency who's going to try to collect the money that you owe to the hospital. While that bill is in collections, it's going to drag your credit score down. As soon as you pay that medical bill in full, it no longer affects your credit score. But that only applies to medical bills. We're going to go way more in depth about what happens when you don't pay your bills in Lesson 4. You just learned about credit score ranges, what information is required to generate a score, and the 5 categories that make up your overall credit score. In the next lesson, we're going to cover what a credit report is, how to understand it, and why you should care.